Okay, let's see here. So tonight, we're gonna do two handouts, bonds, and then taxes and pensions. So I'm gonna jump into chapter 9. Okay, so bonds, what are bonds? Bonds are mini loans. So when a company sells a bond, what they're actually doing is borrowing money. I'll put this on. Uh, so I think I can't remember if I talked about this before or not, but especially for like large projects, to get a bunch of money, if you have to make a factory or something like that, something that takes a lot of money. Sometimes cities will sell bonds to make roadways and stuff that costs millions. They can't really go to a bank for that. Some banks can cover, $3-4 million loan or something like that, but when you start getting to really big money, 200-300 million, what they end up doing is selling bonds, and bonds are like a bunch of mini loans. So if you have to raise, let's say, $100 million, you break that up into 10,000 $1,000 loans. Why? Because there's a lot more people that have $1,000 than have 100 million. And you can sell 5 to this person, 50 to this bank, 100 to these investors, whatever. And so you can raise this money. But these are just like, so when they say selling a bond, it's not really like you're selling something and they're just giving you the money. You're actually borrowing. So when you sell a bond, you give them the bond, it says how much they're going to earn on it, and they give you the cash. Now, you're going to have to pay off those bonds in the future. They'll be 10 years, 15 years, whatever they are. But they're basically mini loans. And especially for large projects, they're pretty much a necessity. Just because you start getting into hundreds of millions and billions of dollars, you can't really go to one bank for that. It's just too much risk, for them. But they might be more than happy to lend you 10 million. So anyway, that's what bonds are. So when they say selling them, it isn't really like free money. It's borrowing money that you're going to have to pay back. And there's a face value to it. How much did you borrow? And what the interest rate is. I can see right now, I'm going to change these in the future. An indenture agreement is similar to a loan agreement. Change. Okay. Okay. Okay, so bonds are similar to a loan agreement. The company must fill part of the indenture agreement. Now, with this indenture agreement, this is kind of like the rules for the bonds. So an indenture agreement is sort of like the loan agreement. So it's the same thing. And it's basically telling the bondholders what they're going to get and what the rules are for paying on that. Periodic interest payments to the bondholders is something called coupon payments. So you see the coupon rate on the bond. And coupons were torn off and sent to the bond issuer to request payment. So it's kind of funny. They used to have like they used to have your bond would have a bunch of tabs on the bottom, and when you wanted to get paid, they say, okay, send this in on March 1st, and you'd rip off the coupon and send it in. If you watch old movies and they talk about, she's up there clipping coupons, that means someone who's very wealthy, that they don't have to work for a living. they have all this money and they just tear off these tabs and some of these coupons in, but that's what coupons, you know, when you talk about coupons in the past, so it's basically interest payments. And so they still use that, even though that, well, actually, they do have some coupon bonds nowadays too, but mostly they're not. And it's kind of an old term, but it still hangs around. So you see coupon rate used a lot. Okay, types of bonds. Secured bonds have collateral, like a bank, like a mortgage. Unsecured bonds, no collateral. Convertible bonds can be converted into stock. Callable bonds can be paid off early. You can pay them, it's sort of like paying off a loan early. Sometimes you can, sometimes you can't. If they're callable, you can. And term bonds, and this is the one we usually use when we talk about bonds, they pay interest and then they have to pay off the entire amount at the end. So for instance, if you sold $1,000 bond for 5 years, you'd pay interest, and then at the end of 5 years, you'd pay off the entire amount. So term bonds, they pay interest. And the face amount there. So it's $1,000 bond, you pay $1,000 at the end of it whenever you pay it off. So every year you get this, or every period you get this interest payment, and there's a face amount. Okay, now one of the things we talk about is the valuation of the bond. Actually, this is where this the one off the off Blackboard and the one where mine are going to change. They'll be a little bit different. But anyway, we're going to go through some of the data, and then over here will be the answer to our whatever the problem is. I'll show you what I mean by it. Okay, so if we have a bond that's sold at the face value of $10,000, and the coupon rate is 10%, that means that every year you're going to pay 10% interest to whoever has these bonds. Bond life in years, and payments per year. Usually 1, 2, 3, actually 1, 2, and 4 is probably the most common ones. I don't know why they don't have 3 payments, but yeah, but 1, 2, 4 are usually what they pay off. Now the yield rate, this is the market rate, and this is actually a little bit interesting. This is where these get a little bit tricky. Because there is somewhat of a problem when you're making all of these bonds up. You're printing out all these bonds, you're going to sell to people. They have the interest rate printed on them. They have to. You know, it's a legal document saying we're going to pay up. Now, when you go to a bank, they'll have that interest rate already put in there, and the whole loan is for that interest rate. Bonds are a little bit different in that the market may not want the rate that is shown on the bonds. They may want a rate that's higher, or the market may be for a rate that's lower based on how, you know, the risk of the company. So notice that you have the people buying the bonds aren't the ones that wrote it up. Unlike the bank, you know, they're not the ones that created it. The company had those created. So the interest rate will oftentimes be different than what the market rate is for the bonds. And it influences the amount people will pay. For instance, if I'm paying 10% and the market wants 12%, you know, there's a problem there. They want more than what's printed on my bond. Now, they'll still buy my bond, they just won't pay the full amount. But it goes the other way too. If I'm paying 10% and the market only wants 7%, they'll bid up the pricing, they'll sell for more than what's printed on the bond. So there's this weird thing that the people that are actually lending the money are not the ones that made the document. That is different than, say, going to a bank and getting a loan. Go to the bank, they say, whatever, 7% interest. That's on the entire loan, and that's what it is. And the market and what the investors want is exactly the same. So it's a little bit different when you have a company printing bond. Okay, so just kind of give you an idea. I'll show you what happens. Like, so here's the face value of the bond. So let's say it's a $10,000 bond, it pays 10%. Now, if the market rate is 10%, it'll sell for exactly what the face amount. This is where I think it shows that at a discount or something here. There's a rounding here for this one that I fixed with the one I sent in the mail, but this should say par value. But anyway, and these are the present value of the payments. They total up to 10,000, and the percentage is that. And issue percentage, I'll talk about that in a second. All right, let's suppose that the market isn't 10%. Let's say that they want 12. So here we got this bond that's printed out. It says it's going to pay 10%. We go out to the market with our bonds that say 10% on it. And the market let's not do that. We'll say, okay, we'll buy the bond, we'll buy the bonds, but we're not going to give you the full amount. We'll give you $8,853. And by the way, this is usually not a shock to the company. The company usually knows what these are going to sell for. It's not like they lost money or anything like that. But the interest rate will have an impact on the bonds. So if the market rate is higher than what is printed on these bonds, again, they'll still buy them. They're just not going to give the full amount. Let's suppose the other thing is true, though. Instead of 10%, they want 7%. Now they want these so much because they're paying such a high rate of interest that they will actually pay more for these bonds. They'll say, wow, that's a lot of interest. Well, we'll pay you $12,132. Questions then? So again, this is the problem of the bonds are printed up. They have a stated rate or a coupon rate on there, contract rate sometimes it's called. And the market might be different. And so if the market is different, it will cause a change in the valuation. And there's one more kind of subtle thing that we'll talk about here. And that is, they'll also talk about an issue percentage. And this issue percentage is simply the bond value divided by the face amount, what percentage of it. So they're getting 121% basically of the face. You might say, well, why do they even calculate? What does that have to do with anything? Well, here's why you have that, because people might buy different amounts of these bonds. For instance, let's say if these are all $10 or $1,000 bonds, and someone buys 3 of them. So if you buy $3,000 worth of these bonds, how much are you going to pay? Wrong place. I want 3,000. Okay, well, you're not buying all of them, so you're gonna have to pay 3,640 for those. So this percentage, this issue percentage is for individuals to know how much, when you're not buying all of them, how much are you gonna actually end up paying? In total, they're gonna sell for that 12,132, but let's say I'm buying 3,000 of them, I'm gonna be paying 3,640. And again, that's because it's a problem because we, break it up. Okay, well, we're gonna do some of these problems, and I think I can freeze the pane. Let me see if I can freeze these panes. Yeah, okay. All right, so problem one, all we're gonna do is put in the numbers for these. So problem one is. Oops. Wrong, 50,000. The interest rate is 5.7. Number of years is 12. Payments are made semi-annually. I think all of the problems have that as semi-annually. So in other words, it's twice a year. And the market rate is 620. And these will sell at a discount. And that discount is because we're paying 570. That's what's printed on the bonds. The market says they want 620. They'll still buy them. They just won't pay the full amount. And by the way, if you wanted to buy 3,000 of them, you'd pay 2,874. Okay, so that's problem one. The total value of the bond is what, 47,906.
Wait, could you repeat that again? How you got that?
The 47,906.
Mm-hmm.
Well, actually, I got it set up so that it just once you put in this data, it'll automatically calculate it. This is similar to what you might find in a financial calculator. I think this section of the book, they actually talk about financial calculators. And if you have one, you can certainly put it in.
Oh, okay. I was just trying to get that formula that you had up in the screen, that function screen.
Which one?
The function screen at the top. Yeah, at the top where you put the function in it.
Oh, well, this is actually this is a little bit convoluted. I've actually got hidden rows.
Oh.
That's in the background. I can explain what it is though. This isn't so bad. This is how many payments? 12 years times 2 is 24. Stated payment is B5 divided by 2. And I think that's probably rounded. It is. And that is before times that. So that's how much interest you're going to be paying out. And the market rate is simply the 620 divided by 2.
Okay.
But yeah.
Yeah, because these might be on a test.
You can always use this on the test. Yeah. You can have this Excel spreadsheet up on the test. Hey, you can also do it. And by the way, this is the same thing you'd get with a financial calculator. That they have this built in, these functions built into the financial calculators. You can just put in all this stuff, put in the market rate, yield rate. They have different terms for it, but yeah. So that there's nothing secretive about this or anything like that. So this is what this bond would sell for. It would sell at 95%. if you're interested in buying them, I'm gonna move this over. You would write a check for $2,874. If you're buying 3,000, if you're buying 5,000 of these, like that. But that's why we have this percentage, because again, if they don't sell all these to one investor, which often they don't, you got to know how much you're going to write. Well, okay, I want to buy 5,000. How much? What do I write the check for? Okay, let's go to problem 2. And again, you're just going to enter this data. If you get it on a test, you can always do same thing. So 100,000 coupon rate is 7.20. $10, twice a year, most of them are, I think. And market rate is 5.5. Now, I want you to kind of notice as we go along here, you'll see that if the coupon rate is higher than the yield rate, if the coupon rate's higher, it's going to be a premium. If it's lower, it's going to be a discount. So in this case, it's a premium. Our bonds are paying so much that the investors will bid up the price, and they will pay us more than the face amount. In this case, they're going to pay us $112,943, almost $113,000. So it's the difference between these two that matters. Whichever one's higher. So this would be, what is it, 112,943. Yeah, what am I doing? Okay, this is what they call a zero coupon bond. You're thinking, what in the world is that? That's when the company says, we're not going to pay any interest on it. You say, well, they're never going to sell those. They will. They just will get a fairly low amount for it. Notice that the present value of the interest payments is zero. They're not making any interest payments. But these are going to be valued at the face value. And as you might expect, if they're not making any interest payments, they're not going to sell these for very much. In this case, they sell them for 54% of the face value. So if you're going to buy 5,000 of these, you'd pay 2,742. You would not get any payments for 10 years. But zero coupon bonds, they do issue them. They just, it's basically a lump sum payment at the end. Is there another one? Nope, that's it. Okay. So anyway, coming down, let me unfreeze this for a second. So coming over here, these are just kind of some of the rules you have. Relationships between the coupon rate and the yield rate. If the coupon rate is equal to the yield rate, or if the yield rate is equal to the coupon rate. Notice that these are exactly the same. These are both saying the same thing. If the coupon rate's equal to the yield rate and the yield rate's equal to the coupon rate. If they're exactly equal, they'll sell at 100%. And that's called selling at par value. If the coupon rate is less than the yield rate, or the yield rate is more than the coupon rate. I may have a better way of putting that. So the coupon rate is less than or the yield rate is more than the coupon rate. You'll notice those are exactly the same thing. Right, I mean, these are exactly the same. It's gonna sell at a discount. So if the coupon rate is less than the yield, or if the yield is more, it'll sell at a discount. And as you might imagine, if it's just the opposite. If the coupon rate is greater than the yield, or the yield is less than the coupon, exactly the same argument. It will sell at a premium. Finish this off. So these will be discounts. These will be premiums. All right, any question on that? So the problems you have will be similar to that. You might get on the multiple choice questions, you'll have some of these. We'll talk about the indenture agreement. They'll talk about the different types of bonds. In the multiple choice questions on the test. But the homework problems are basically based on this, and you can basically answer these oftentimes. One of the problems we'll have just based on whether the coupon rate is equal to the yield, coupon rate is less than the yield, or the coupon rate is more than the yield. And then you can say whether it's a par, discount, or premium. Question on that? Okay, and again, this is something you can use a financial calculator, and if you're used to using a financial calculator, then by all means use it. Nothing wrong with that at all. I don't like using financial calculators in class for a couple of reasons. First of all, they can be kind of expensive, and if you're not a finance person, it's kind of a big expense to say you guys got to buy this for the class. But also, there's also different kinds of these. There's a number of different ones, and so you end up with, okay, I got a Texas Instrument, I got a whatever. You end up, it can be confusing, clicking through class trying to figure out who has what kind of calculator and what the terminology and how it's laid out is. But if you have one and you're used to using it, by all means, feel free. Okay, let's go to taxes and pensions, two of the most complex things in accounting. Okay, talking about taxes first. One of the things that's confusing about taxes is they talk about income tax. How much income did you make? We're going to tax it. The more income you make, the more we tax. It's not really that simple, because the government tries to encourage certain things and they try to discourage certain things. And they do that through the tax code. And so what they're talking about for taxable income is really not the same as your regular income that we would think about for accounting. It's the income that they want to use for taxes. And again, it does not necessarily mean that it's an accurate income for you, and oftentimes it's not. But they want to encourage certain things like investing and all that kind of stuff, and discourage other things. So it kind of is that it's not exactly that they just want to find out how much actual income you made. They also have activities they want to encourage and discourage. And there's also some things that are just practical that they throw in, and we'll talk about those in a second. So what you end up with oftentimes are what they call timing differences, temporary differences between what we account for as income for accounting rules and what the IRS rules are. Sometimes the IRS has you recognize things earlier than you would for GAAP. Sometimes later. So revenues, money coming in, this is money coming into place. They have different rules for it than we do for regular accounting. Let's go and talk about these for a second. So for instance, rent received in advance. If we get rent in advance, we can't count that as rent because we haven't earned it yet. So let's say I'm renting a building. A tenant gives me $1,000 rent ahead of time. Let's say that you haven't paid, for instance, a deposit or something like that. They pay you ahead of time for the rent. Now you haven't earned it yet. So accounting wise, you can't count that as income until, if they paid you for January, ahead of time, you can't count that until January when you'll have earned it. Those are the accounting rules. Now the IRS takes a different view of that. They said, well, wait a minute, you have the cash already. You can pay the taxes on it. So the government says when you receive the rent, that's when you gotta pay taxes on it. We don't care that you haven't earned it or not. You now have the money, you have the cash in hand. So now that you have the cash in hand, you can pay the taxes on it. So they have you recognize it early. But it goes just the opposite way too. If someone didn't pay you rent in January, they're not going to pay you until later on. They don't count it until you actually get the cash. Their reasoning: if you don't have the cash, you can't pay the taxes on it. So that's kind of a practical timing difference that the IRS has in, for revenues, for example. Now, expenses. Where am I at here? Now, for taxes, are expenses good or bad? If you're paying taxes. If you're paying taxes, you love expenses. The more expenses you can find, the better. And the government knows this. And so one of the things they're very generous with are depreciation. They allow you to depreciate something that you buy very quickly. And they do that because they want you to invest in your company. They want companies to make investments. So they say, hey, if you buy something, you can expense a whole lot of it, possibly even 100% of it right away. So, you get this incentive for people. Now, is it exactly, is it a good measure of income? No, but that's not why they're doing it. They're doing it because they say, look, we know you like expenses. Here's a big expense you can have right up front. And so, because, why do we want you to invest in your business? Why do they want that? They want it for a couple of reasons. First of all, if you're buying more stuff, keeps the economy going. Second of all, if you're buying more stuff, keeps your business going, and you keep hiring people, and the people that you hire, the government taxes them also. And they really like it when you keep a business going. They want you to invest in it. They want you to make investments. So that's why they're very generous when it comes to investments. And one of the reasons that way they do that is by depreciation. If you invest, if you buy something for your business, a piece of equipment, whatever it is, you can write off expense a big chunk of it, and that's a great thing. Yeah, so, and that's a very common one, the depreciation. There are some things, though, that they don't like. The government does not like you to make estimates for obvious reasons. Because if these are expenses, if you're making the estimates, you could really make the estimates crazy and high. And so the government says, no, 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 only the actual amounts that you pay out, for instance, for warranty expenses, only the actual, not what you estimate, but the actual amounts. We will count for warranty expenses. So they don't like estimates. And they discourage those. Okay, let's see how this plays out. So when companies make their income statements, this is for what they give to people, show people the bank and all that kind of stuff to show how well they're doing. They will base their calculations on this pre-tax net income. And they'll come up with their provision for taxes. This is probably 30%, I would guess. I don't see the calculations I had in there, but so this is, if you were to look at a company, if they had made the same amount every year, this would be their net income after they paid it off, after they have this provision for taxes. Okay, we come down here. So this is our taxable, our tax return. And it's going to be based on our taxable income. Now, because the government is very generous with these expenses for depreciation, you may very well have a taxable income that is much less than your pre-tax income up here above. Now, you notice how little your taxable income is. This, you love this. This is, if you're in business, this is what you like to see. A little income, not a lot. And so your taxes payable will be 400, and your after tax net income is going to be 600. And this is, again, this is really not net income because it's kind of like tax income, but it's basically what they're basing it on. Now, eventually, though, you run out of cost. So, for instance, I buy a piece of equipment for say $1,000. The first year, they say you can depreciate a whole bunch of it. Second year, a little bit less, but still pretty good. Eventually, that 1,000 runs out, and eventually, it runs out for higher, I'm sure for accounting purposes too. If you paid $1,000. You're going to expense 1,000. It's really just a timing difference. They're allowing you to expense it up front, which you like, but at the same time, eventually it's just a timing difference. There's only $1,000 in there, whether it's for tax purposes or for accounting purposes. So eventually it's going to catch up, and that's kind of what this is showing here. This provision for taxes, if we add all these up, you'll see if they come out exactly the same. And this And the same thing for the after tax net. Now, it's true you got to save some money up front here. But in the end, it'll reverse out. Because you simply run out of the cost of it. You run out, pretty quickly if you're gonna depreciate a lot early on. But no, it is a big incentive. If you tell somebody, look, you're gonna avoid up $500 and the taxes on this first year, that's quite a bit of money. Okay. Now, we are going to have a difference between these two. And that's going to be a liability because these amounts that we're paying for the government, they're actually different because of the depreciation, between those two. But we're going to have to pay it later on, as this kind of winds out, this is going to change. Okay, so our deferred tax liability. So for the first year, we should have paid 900,000. We only paid, 900. We only paid 400. So this first year, that's going to show up as negative. I think I got to do this differently. Hold on. No, that's right. Just do it, Mark. Yeah. Now, the second year is going to add up to even more because we're going to have 900 and 650. And so it'll add to this. I'm going to put on another row down here. Total. So the next year we have more that we're going to add on to this pile. It's maybe more confusing the way I put it. I know how to do it. I'm just gonna copy them all over. I'm sorry. And this should turn out to be 0 at the end, and it does. Okay, so here's a deferred liability. So the first year it'll be 500. Second year it will be the 500 plus that. I think I just copied this straight over, I think. Yep. So this will be our deferred tax liability in total. First year is just 500. Second year it goes up to, we had another 250 on, goes up to that. Third year we pay off 300 of it. Goes down to 450. Fourth year we pay off the 450, and so it goes down to 0. Weird, huh? But it's just a timing difference. So this deferred tax liability, this is just a liability to be shown on your books. And the total amount for that deferred tax liability will be down here. And so the first year you'll show $500 on there that you owe the government. You show $750 that you owe the government. Third year, you're actually paying off some of it. In the fourth year, you pay off the rest of it. So it's a timing difference. I know this is kind of a quick way of going through it, but you know, if you're an accounting major, this is a good 3 weeks we spend on actually doing these calculations. So it is a little bit of a, I don't know. But anyway, so this is the liability though. This is the deferred tax liability. How much of it is deferred? Maybe we'll see if we do the problem for this one time. Okay, let's go to the second problem. Oh, okay. This is kind of the same thing. So this is the current taxes payable. Down here is the deferred taxes. And then this is the total. So our tax expense would be the total amount. This is our tax expense. The amount we're going to pay is up here, the payable. Why space he's out so much? Oops. And the amount that will defer to the future is this up here. And so this is a liability that's deferred to the future. Oops.
How did you get that 10.5 again?
I just added all these up. You know, actually, if you just added those two too. And so your expense, so this total, this is going to be your expense. And so what it's saying is, okay, you got this expense, it's $10,500. So that's you're going to have your tax expense. However, the government says, okay, you only have to pay 8,000 of that. But then you have this going into the future of 2,500 that you're going to pay off in later years. Sort of like if it was a payable. I mean, you know, the taxes payable. If you paid off 8,000 of, if you have 10,500 that you owe, and if you pay off 8,000, well, you still owe 2,500. So you still have a liability, or you still owe, isn't a way to say it, 2,500. It really is, again, the government is trying to encourage you to, do certain things, whatever it is. But they really just are timing differences. They are not permanent, what they call permanent differences. They do have permanent differences, but the ones that we worry about are the timing differences. And depreciation is the big one. I'll tell you something kind of funny, and that is we didn't used to have depreciation expense until we had income taxes. Prior to having income taxes, depreciation expense didn't exist. Because there's no cash involved. I think we talked about this before. We did the statement of cash flow. You drive a car off the lot and it's worth $3,000 less because now it's a used car. You actually don't make a check out for $3,000. So they never counted depreciation expense until they got taxes and they started looking around for expenses. Okay, we need to get some more expenses because it'll reduce what we pay. And so that's how depreciation expense came. Okay. You guys just want to push through and do the pensions, or do you want to take a break?
I'm fine if we keep going.
Get it done?
Yeah.
Okay. All right, pensions. There are a couple different kinds of pensions, and the kind of pensions most people have are the kind of pensions that most people have are 401k. I have a similar pension to that. It's where generally the employee puts in some money, the company puts in some money to this pension, and when someone reaches retirement age, they can then take that money out. It doesn't get taxed. It gets taxed when they take it out when they retire. But that's what they call a defined contribution. That is defined in that the company will pay in a certain amount. Now, there also is what they call a defined benefit pension. And these were very popular for years. And they're really just incredibly expensive now. And there could be huge dollar amounts involved. And that is when someone retires, the company will say, we will pay you a certain amount of your salary every year. Maybe your last salary will pay 60% of it, or whatever the terms of it. And these are very popular. And nowadays there are not as many places that have them. Some governments still have them, but businesses a lot of times don't. But because they're incredibly expensive. Back in the 50s and 60s, people didn't live that long. A lot of people smoked, a lot of people drank, a lot of people did all kinds of things. They didn't have any, for instance, they didn't have any gyms. Nobody went and exercised, and people who jogged, you could count them on your hand. There weren't that many of them, and it was just a very different thing, and people didn't live that. I think the expected life expectancy for a male was something like 64 years old, something like that back in the 60s. So anyway, you had the people that were retiring at 65, and a lot of times they wouldn't last more than a couple of years, and it wasn't that big of a deal. And you had a whole bunch of people working in the company. Maybe you had 120,000 people working in the company, and there was 4,000 retirees, and they don't live that long anyway. Okay, now come to today, people live into their 90s all the time. They'll be living 30 years past their retirement is not uncommon. Big difference between someone living 3 years and someone living 30 years past retirement, and health insurance and all that kind of stuff is just through the roof now. So, you have this big, these big liabilities that are on the books, and people are just living so much longer, and they're very expensive to have those. So I'll give you an example. When I worked at Navistar, we had 11,000 employees, active employees at the company. We had 39,000 pensioners. We had 3 times as many people retired as we had actually working. So that will kind of give you an idea of how big these problems could be for some of these companies. It's not uncommon to have a pension fund that has more assets than the company itself. It's very common. When I was at Navistar, we had that. Our pension fund was way bigger than the company. So let's see how they actually work this out. Okay. I'm gonna go over here to this kind of the structure of it, just to kind of show you what basically happens. The pension is separate from the company. So if this is General Motors, their pension fund is separate from General Motors. By the way, I'm just saying General Motors, it could be anyone who has this kind of a program. So what General Motors does is they will send cash payments to the pension fund. And the pension fund invests that money. So they're called the plan assets, and they invest that money in stocks and bonds and all that kind of stuff to try to make more money on this. Now, the pension fund has a great big liability. So they got these plan assets on one side, and they have these liabilities on the other. What are the liabilities? The liabilities is what is owed to the pensioners, and you're going to pay them off. But these liabilities are liabilities that the pension plan will pay to the pensioners. Okay, so big liability. And oops, oh, I moved one of the retirees. Sorry. But these will be paid to. So this is kind of the way the schematics of it. Cash goes in, that cash gets invested. There can be huge amounts of dollars in here, but there's also huge amounts of liability over here. And so that is kind of how the pension plan works, kind of how they look. Okay, so coming over here, we have these plan assets. By the way, I think this is for General Motors. If you look at these, you know, these are pretty big numbers. These are in millions. So in 2021, their pension plan had 134 billion, $400 million in the plan assets. At the beginning of it, at the end, they had was 139 billion. And they also have these liabilities. Okay, so these are the liabilities. So these are the plan assets, and these are the liabilities for them. All right. Now you'll notice from one year to the next, the plan assets will kind of switch over. What I mean by that is the ending plan assets in 2021 will become the beginning plan assets in. And the same thing down here. Okay, let's see how this actually works though. So coming down here, I'm going to put the plan assets at the end of the year. So 2021, we had plan assets. We had, enter the, this is a PBO. So they had 139 in assets, 139 billion in assets. gonna add 164 billion in liabilities. So this was, the fund is underfunded by 25 billion. You come here, plan assets. Put that as a negative. And 2022, they're only underfunded by 16 billion. It's very common to have pensions that are underfunded. For a number of reasons. First of all, you're talking about astronomical dollars. And second of all, actually taxes is part of it. The government, again, the pensions are based on estimates, and the government doesn't like estimates, but they will limit sometimes the amount that companies can put into those to write off in, contributions to those funds. So there is sometimes a tax problem that keeps companies from funding those 100% because they're not allowed for tax purposes to fund them to a higher percentage. Okay. How will GM's pension position be reflected on its balance sheet? It'll be oops, you'll have a pension liability of those two amounts up there. Okay, and this is where it gets ugly again with the increases and decreases in rates of return. All right. Obligations. And this comes back to where this over here. Let me copy this down here. Oh, it's already copied down here. Let's just jump right in here to these. What color is pension obligations? Blue and okay, lowering the discount from 520 to 450 in 2022 will increase or decrease the pension benefit obligation. Okay, so lowering it. Come here to pension obligations, change in the discount rate. This would be a decrease. So it will increase. Pension benefit obligation. Okay, expected rate of return. Return on planned assets will, okay, so we're in this situation here. They could rate a return from 5.5% to 6.3%. That's an increase. So it'll increase the value, and this one's a little more obvious because obviously if they're making a higher rate of return, they're gonna have an increase in the planned assets. So this one will be an increase. And there's a problem like this on the. I don't know if there's a problem on the test on that. I'm not sure. I can't remember, to be honest with you. That's the look. But there's definitely a homework problem on that. And that's it. Kind of a wacky, kind of three kind of crazy things: bonds, taxes, and pensions. This, by the way, these are what you get in the advanced accounting class. This kind of stuff you see on the CPA exam. Especially stuff like this. They give you this information and they'll ask you some questions about it. Any questions? He is asleep. Be quiet. Okay. One thing I gotta ask you, I put the grades through. I entered them from Monday yesterday. So they should be updated as of yesterday. If there's other ones, if you did something between yesterday and today, it won't be in there. But can you do me a favor at some point? I just take a look at your grades in Blackboard and make sure that they are like as they should have been on Monday, basically.
Yeah, all of mine are there.
They
Sure.
looked fine to me.
Yeah, they'll find me as well.
Okay, good. All right. Yeah. So anyway, there's still some that aren't coming directly over, but I can just copy those in and it'll be fine. All right. Any questions?
No, I'm just gonna tackle these problems and I'll reach back out to you.
Absolutely. And if you guys are going through any of this stuff, if you have, if you get stuck on a question or whatever, if it doesn't make sense or whatever, feel free. I'm available almost anytime. The only time I'm not available is, well, obviously now.
Tuesday and Thursday.
Yeah, Tuesday, Thursday at 6.
Yeah. But you're available early on Thursday, right? Earlier in the day, right?
Yeah, I can do most.
Okay.
Anytime, usually after like 9:30.
Okay.
That's when I take my dogs around. I can't take them outside until people have gone to the train, so they don't harass the train.
Okay.
But yeah. So,
Cool.
all
Thank
right.
you.
Professor, one more question. Sorry, we're not meeting next Tuesday, right?
Oh,
The holiday.
It's the
yeah.
4th.
Do you want to meet on a different day? Or just not? Yeah. There'll be one more class, so it
But meet on a Wednesday?
Or even Monday, maybe.
yeah, we could, let's see. Well, you guys might be out of town though, too, right? So we can meet on I can't remember when do I have this thing ending anyways.
The 17th.
The 17th.
Oh, so we can definitely meet the following week. Okay, so we'll take off next week. Wait, I'm doing something stupid here.
Okay.
So then meet the 11th then?
Check and make sure. Yes.
Okay.
Yeah, we'll meet the 11th. Yeah, because I know some of you guys can be out of town.
Are we the only ones in your class, or do you have like a really big class?
It's a really big class, but it's a mixed bag. There's some people that are done. there's some people that haven't started yet. I'm not sure if they are going to start. It's a real mixed bag.
I'm just saying, because I see the same name, so I was wondering if like they combined our two sections, because there was supposed to be two sections of this class.
Yep.
Because there was like a small group, or if you have more students. I'm just being nosy.
No. I mean, there are a total of, I'm just gonna take a look here.
Yeah, a lot of people, I think, look at the recordings.
Yeah, and there are some people that look at the recordings and turn in.
Yep.
There definitely are people that are doing that because there are multiple. There are probably 10, 12 people at least that are turning in the extra credit points. But there's probably, well, there's 31 people in the class. But now there's only about 24, 25 that are actually have bought the program. So I'm assuming those that haven't bought the program are probably not going to be in the class. So probably like 24, 25.
Okay.
Yeah, a lot more though that you guys showed up. But you know, I don't know. I like doing the if it was up to me, it would be taught as a regular class. That's not the way they show it. That's not the marketing of it and all that. So, but yeah, and again, if you guys have any questions on the homework or anything like that, feel free to reach out and we can set up Zoom meetings and go over it.
Okay, cool. Thank you.
Thank
Thank
you.
you.
Thanks, guys.
Bye-bye.
Have a good one.